Okay, great. Thanks, Madison. So today we're going to be going through a number of different topics regarding the insurance industry. Before we start, I just want to mention a little bit of what we're going to go through. So we'll talk a little bit about the state of investments to insurance-related startups. And then we'll go through just a few different themes that we're sort of focused on or thinking about this year, especially as we progress our own research coverage of certainly innovation in the insurance industry. So we'll be talking a lot about different startups, a lot about initiatives from carriers. I will say it's a largely U.S. focused presentation, so we will not necessarily be going in depth into some of the big markets, obviously Europe and others, but we'll touch on aspects of what's going on in many of the markets as well. So hopefully this gives you just a taste of a little bit of what we're doing and covering in the insurance industry. And if you're following some of our previous presentations and newsletter, certainly this won't be really new to you. We'll be recapping a lot of what we've seen, especially in 2018, and thinking about as we head into the latter part of this year. So with that, why don't we start with looking at sort of where we are in terms of investment to insurance-focused startups. On Just this week, we actually just launched the newest iteration of our report, Willis Towers Watson InsurTech Briefing through Q4. So a lot of new data in that report, as well as a great focus on cyber insurance as well, which I won't touch on in this presentation because of that focus in that report. But we have seen sort of global insurance tech investment reach about 4.15 billion in 2018. If you go back just a few years ago, that was up from about 200 to 300 million in 2013. And so it's certainly there's a lot of substantial investment going into insurance-focused startups. And when we talk about what's in this cohort of companies, that's companies that are selling insurance digitally. They can be brokers or managing general agents or carriers, or companies that are selling software, data analytics tools to the insurance industry, and that obviously comprises a whole number of different types of companies. When we look at when we break down that figure, right, in terms of how that figure breaks down in terms of where the large investments are going. Well, in 2018, certainly we did see large investments accelerate. So investments of sort of certain size, right? In this case, if we look at investments just over $30 million, there was actually 28 different investments. And of course, that breaks down differently in terms of some of the intermediaries that are in the space, as well as more enabling technologies, as well as companies that would be deemed, quote unquote, full stack, right? Companies that are trying to sell insurance, but also, as licensed entities in the U.S. or other geographies. Those are companies like Root Insurance. Obviously, there's been a lot of investment in the Medicare Advantage space, Oscar, Devoted Health, as well as Clover Health and others. And also, we're also seeing this globally as well. So if companies like Singapore Life, Digit Insurance in India, and Koya in Europe, also raising significant financings last year. So this is just sort of how that breaks down, basically showing you that a large portion of that total investment figure is broken down actually into not that many companies, only 28 financings here comprising almost 3/4 of the funding. Of course, as we continue to highlight our coverage of different industries, especially as we see an outgrowth of different startups in those industries, is this aspect of the venture capital funnel. So a lot of companies that we're covering here have raised venture capital, which tends to be a bit of a natural selection process if you think about companies that raise seed funding and go all the way to become billion-dollar outcomes. In insurance, I think it's still quite early in terms of startup mortalities, as well as consolidation in terms of startups in the space. Still seeing a lot of follow-on financings. We did see some companies last year, especially sort of be bought out or sort of coalesce into other teams, whether those were in PNC or in life insurance, or sort of also in health benefits. So we are seeing a few of those companies, but expect to see more of that as the space consolidates more as it matures and goes through the spectrum. So what are some of the topics that we're looking at this year? We released a report called sort of PNC Trends to Watch, and some of that material will be rehashed in this briefing. But one of them is telematics, and that's quite simply because we're seeing a lot more insurance executives talk about telematics as a priority or a strategic sort of having a strategic process around it moving ahead. So why don't we dive into that a little bit? If you look at sort of the recent quote by Tom Wilson, Chairman and CEO of Allstate, he mentions that he believes that in the future telematics could be the primary driver of insurance pricing and auto insurance because it's every bit as powerful as credit. Of course, it does require the customer to do something, and it requires a significant amount of sort of pull from the user as well as getting that sale to go through of a telematics-based policy as well. But believing that it's equally as powerful. So why is it becoming more of a focus for auto writers? Well, some of the common benefits that we hear about are sort of risk selection in terms of telematics attracting better drivers, potentially increased customer engagement and safety, as well as things about thinking about claims handling and accident reconstruction, fraud tracking. If every policy is for some startup carriers, or at least is done through the mobile device, and you have a lot of every user is onboarded through mobile, that presents interesting opportunities thinking about down the line in terms of accident reconstruction, fraud tracking, and potentially more accurate underwriting as we think about more trends such as distracted driving and potentially even in longer term or more in the medium term, sort of more marijuana legislation in more states. So these are things, as we've seen, sort of, we have seen some different trends around claims in the auto insurance space, especially around claims frequency versus severity, and that changing certainly what pricing looks like. But it's interesting to think about telematics in the space as well. And one thing, as we mentioned, is just how many executives are talking about this. So when we use the CB Insights database here and we search our earnings transcript search engine just for the term telematics, we've seen a significant amount of growth, right? So you see that over the last few years, a lot more mentioning of telematics. Obviously, these are not all insurance companies that are mentioning this, but there are within this, increase in mentions is a number of different carriers who are now talking about telematics. Some of the recent ones in the last quarter include Intact, Hanover, Erie Insurance, talking about some of the new programs they're adding, whether those are new pilots for young drivers or coaching products that they're offering, or sort of just updating prior telematics offers. So a lot of attention on this, and it's something that we'll continue to watch. Of course, when we think about adoption, it's still quite low. Some data from IoT Insurance Observatory projects that there's about 4.4 million U.S. policies sent telematics data to insurers in 2017. That's out of 14 million total. But what perhaps a more striking figure is that I believe that not less than 9% of global telematics policies were characterized by usage-based pricing, meaning that the initial policy pricing is not impacted at all by driving. So you might get a policy, and then that might affect the potential renewal of the policy. But certainly, that being the majority of what's going on in telematics today, not necessarily sort of like a try before you buy model, as we've seen with some of the startups like Root Insurance utilizing. And of course, in the U.S., we're also seeing a bit of bifurcation in terms of how much data is being collected from auto insurers in terms of telematics. Progressive and Allstate, for example, collecting significant amounts of driving data. Allstate through their subsidiary Arity, Progressive, through the Snapshot program that they have been had for a long time. And of course, telematics continues to evolve as technology changes and behavior shift. If you look at that image on the far left, that's Progressive's Autograph product that was originally almost 20 years ago that was launched. And then you see sort of in the middle there, Discovery Insure's product in South Africa. And they've seen some significant results actually in terms of lower road fatalities and powering this largely through fuel cash back and trying to engage their customers through some of these friendly offers. And the last there is Root Insurance, which has grown to about 1 million installs in the Google Play Store versus Progressive Snapshot, which has been in the App Store for longer, but about 100K installs. So certainly there will be, continue to evolve both on the technology side, on the adoption side, and still a lot of questions around sort of agencies selling telematics-based policies on whether insurers also will continue to double down and look to spend the resources in terms of the technology or engagement that they want to get out of these programs. So it'll be interesting to watch down the line, especially this year, if we notice any big developments on the telematics side. Another topic that we're a little bit interested in, especially given our roots in tracking investment flows, is sort of the insurer as VC model that's really taken hold. If we look at the latest data that we sourced from our corporate VC activity report, unicorns certainly within the tech ecosystem have boomed, but across all CVCs in all industries, only 3 CVCs actually invested in a unicorn in a Series B or earlier, and all of these CVCs are tech companies, that the Google Ventures of the world or the Intel Capital. So this is quite interesting as we think about just the broader corporate venture space. Certainly, a lot of insurers and reinsurers are much more interested in the strategic element of deal making and what this can add to elements of customer engagement or underwriting or just having some complementary value proposition. When we look at our latest data that we released this week, we find that sort of strategic investments by insurers and reinsurers have grown significantly, right, from just a few deals to the hundreds in 2017 and 2018, but seem to be leveling off a little bit. This remains to be seen whether we'll see this trend continue or actually trend downward even further in 2019. But something worth watching. But at the same time, as the number of investments have leveled off, we have also seen insurers crop up as lead investors in a lot more insurance-related startup deals. If you look at just the last few months, some recent ones include CoverHound, which was a deal led by Hiscox, the comparison startup, as well as Limelight Health, Human API, Insure, which is also working with Munich Re on the capacity side. So a lot of more of deals in terms of both insurtech or even just insurance-related startups. We're actually seeing insurers get involved, providing sort of significantly more backing behind some of these companies that they find strategic to their efforts, which is something that we didn't necessarily see even a couple years ago, which is this sort of lead investor role that insurers are taking on and syndicated with other insurers as well, which has implications, could have implications in terms of how these startups, what these startups look like down the line as well. So some are doubling down in terms of insurers with bigger funds or new strategies, but we expect that others will also slow down or in some cases end their programs entirely. That said, it's hard to predict right now, but we have seen some larger efforts underway. Probably most notable, Allianz announcing recently that they'll boost their VC fund to $1.1 billion for tech and insurance deals. AXA recently raised a new $150 million early stage fund. We saw a new strategy by MassMutual Ventures in Southeast Asia to launch a smaller fund to target startups in that region. And then we also saw other funds look to boost their corporate venturing activity, like Aflac, Cigna. So even just here, in the billions of dollars of investment in terms of new efforts that are coming down. But we'll be doing some deeper analysis in terms of what does corporate venturing in the insurance space look like, who's slowing down pretty shortly. So look out for that. Another topic in the U.S. That has gotten quite a bit of attention in the insurance industry is the $100 billion small commercial insurance business. So this is a space that is fragmented, but in many cases profitable, and there's significant amounts of opportunity in terms of digitizing what small business insurance look like. One of the most popular reports that we saw a few years ago was this report that BCG and Morgan Stanley put out, in which they believe that by next year, about 15 to almost 30% of small business insurance would be sold digitally. Of course, this was done a few years ago, and when we look at where we are now, it's probably not accurate, but certainly there is a lot of effort underway to really simplify the process of small business insurance for owners. So this is being seen both in terms of startups as well as incumbents. So Next Insurance, which just recently released their end-of-year report, says that they're on about a $44 million premium run rate. And their strategy so far has been to expand both the verticals that they're in terms of the businesses that they cater to and expanding the types of businesses they're able to provide insurance to, as well as the lines of business insurance that they offer. So starting with liability insurance, but also moving into other lines like workers' comp and others, towards this longer term goal of becoming more of a one-stop shop. So it will take time and effort in terms of building that up, but certainly we're seeing some progress by some of the startups in the space. And we've also seen some moves by incumbents as well. So some of the recent ones we saw both late last year as well as this year were moves by players like Progressive, which launched a business quote explorer in collaboration with a startup called Bold Penguin. And this is essentially what this is a new portal that provides their small commercial insurance marketplace for both agents, carriers, and end customers. And they soft launched this in Q3 of last year with a few carriers, but eventually they've stated that their plans are to write their own general liability and business owners policies on their own paper starting this year. And they believe they can do this because of brand and certainly flow of customers. So it'll be interesting to see how this effort progresses over time. And just recently, Berkshire Hathaway launched a new product, or said that they will be launching a new product called 3, which is a new direct, sort of more comprehensive insurance product, which combining close to maybe a dozen types of different coverages like workers' comp, property, liability, commercial auto. It's already been approved in a few states for a soft launch this April. And you might recall that this is actually in parallel to another effort that they have called Byberg, which is continue to operate, which is largely writing new workers' comp business. But you see these efforts in going direct to small business, and this is another one here with a more comprehensive policy geared towards small business owners. So certainly a lot underway from both startups and incumbents in the small commercial space. There also has been some movement in terms of startups looking to provide flexible insurance products to independent contractors. This is an area of startup formation that we've seen over the last few years, as well as partnerships by carriers with those startups. When we think about this year, we expect distribution to become sort of a bigger focus if these products are to take off, and those might be through on-demand job marketplaces. Those might be through channels such that have aggregated a large amount of contractors, like home webs, sort of home project marketplaces, or even through firms like construction sites and obviously large commercial real estate services firms. So it'll be interesting to see how distribution of these types of products changes, especially through some of the platforms that are now available. Notably, there was a study of the gig economy that recently came out, and Wall Street Journal covered it a bit, in which they believe that the on-demand economy was actually smaller than was once expected because of some data-related issues. We'll definitely remain to see how that turns out for different startups in the space, and whether distribution can sort of change over the next few years. So it'll be interesting to see that, as well as another thought that we're focused on is really what is the ultimate impact of data and distribution on small commercial insurance. So already today, you can get sort of pay-as-you-go workers' comp. You can go, using a platform like Gusto or Square or Intuit QuickBooks. You can integrate this, your workers' comp, and that changes, that is dynamic, right, in nature. But what about all these other data sets that we're starting to see, large platforms that are aggregating small businesses? What else can they do? We have Gusto, for example, works with 60,000 small businesses, and platforms like Square have already used technology as well as the data that they have and access to small businesses to create new business lines like Square Capital, which has lent out over $3 billion. Gusto launching also a flexible pay product. So could this also impact the small commercial space? And you see here an interesting patent that just hints at what Square is sort of capable of, or some of the bigger platforms are capable of, in terms of using their data and in terms of predicting and funding a business need. But you can imagine how this could be interesting in insurance context as well. So something we'll keep an eye on as well as we think about the small commercial space. Another topic that comes up quite a bit is, obviously, full stack insurance startups. So these are licensed insurance startups, and we think that it's very instructive to view and understand how these startups are evolving or changing. A lot of data is available publicly through filings, and it's an instructive way to pay attention to how the quote-unquote insurtech space is growing or evolving. So it's interesting to see some of those changes over time. We've been keeping track of some of the figures here. This is data through Q3 of premiums We're not showing you all the data here, including obviously losses, but there are, also newer figures available through some of the year-end reports, whether those are figures like Root, explaining that they grew direct written premiums to more than 100, implying that they wrote, over 40 million in premiums in Q4. Next Insurance also disclosing some of their run rate figures, and Lemonade also talking a little bit about their figures through some of the writing that they did recently on their results. So a lot of interesting learnings from these results, as well as how the startups interpret or discuss them in light of their strategies. In China, Zhong'an, which has obviously been public for some time now, is also evolving their strategy, both in terms of expansion into tech services. A big announcement in January in which they announced they'll be partnering with Grab to offer insurance products. And you can see some of the figures here around what that opportunity looks like for Grab for Zhong'an in terms of getting into the tech services business and working with different insurers or platforms in markets like Southeast Asia, Japan. And we also see them shifting their business over time. The popular policy that a lot of people talked about with shipping and returns insurance, that's actually been reduced to quite a small, much smaller business than it once was for Zhong'an, and you'll see that shift there on the chart on the left there. We're not going to go through all of the full stack startups, but another one that tends to get less attention is actually Allianz Insurance in France. This is a company that's providing supplemental health insurance on top of what's been mandated in France to small businesses and freelancers. And you can see some of the evolution here that we tracked over time from what they're doing. They've launched new tech products in terms of offering a map for policyholders to find dentists or general practitioners. They have two forms of coverage, one for a higher end product that's aimed at sort of companies that want to retain their employees, so you can see the differences in terms of their coverage, as well as adding things like life insurance with one of their shareholders, CNP Assurances. And their growth so far, they just recently raised another round of financing from Index Ventures and DST Global, growing from about 7,000 employees to 27,000 employees at the end of this year. So interesting to see, different companies in terms of the full stack startups that we're seeing evolve, not just in the U.S. but globally and in all types of different lines. So it'd be interesting to continue to track, how some of these startups evolve and grow over time. Another topic that has come up more for us is the topic of where insurance is growing, where the markets are growing. And one of those is certainly Southeast Asia. When we look at sort of recent data from Google and Temasek, they've discussed sort of the internet economy and the opportunities for growth there. Indonesia is what we'll talk about primarily on this briefing, but all of sort of different markets, which are all very different and nuanced in their own ways, both in terms of population, in terms of the economy, and in terms of demographics, all very different and nuanced, but certainly a lot of opportunity as we see the digital economy take off in a lot of these different regions. And Indonesia is, the largest, obviously, there with over 260 million people, and features particularly compelling sort of macro backdrop. Right, there's half the population is under 30. People are very optimistic in terms of their opportunity to advance their careers and build their finances, and certainly also projected to have the third largest middle class among emerging markets by 2050. The other thing we didn't discuss is also smartphones, and Indonesia rapidly growing their smartphone penetration over the last few years. So in Indonesia, we see a few different influences on where we'll see insurance evolve in this fast-growing market, both on P&C and life. One is the influence of major platforms in driving policy growth. So Grab and Gojek both involved. We just talked about Zhong'an's partnership with Grab, Gojek partnering with firms like Pasar Police, which enables their drivers to get sort of small short-term policies. And we believe we'll continue to see these platforms evolve their role in financial services over time, just given their reach and given the fact that a lot of consumers don't download, too many apps because of sort of data usage and limits on smartphones. So apps like Gojek and Grab, which aggregate a number of different services, are quite crucial. We'll expect financial services to be a big portion of that continuing through the future. And the other thing in Southeast Asia and certainly Indonesia is this influence of different models, not just in not just from the U.S. but also from China. So we've seen startups take influence from Gusto, for example, with tech-enabled health benefits, payroll, as well as offering insurance products, and models like Passar Police, which is largely a B2B2C model, which partnering with firms like JDID, Tokopedia, Gojek, and you see there sort of the comparison with Zhongan, which is also limited some of their biggest shareholder partners, but still largely a B2B2C strategy with a number of different partners continuing. Another topic that to watch this year is potentially the possibility of ancillary M&A. So more largely, we've seen a lot of consolidation in certainly, especially the P&C industry with large deals like AXA XL and others. Consolidation, but we're also potentially could see some ancillary deals by insurers for other types of services that they're looking to provide. So, will this grow? Well, a lot of professionals in the industry believe that it won't, or it's not the best outlet for innovation. This is from a survey we conducted earlier last year. But we have seen some insurers actually drive these efforts more aggressively over time. One example would be Allstate, which has used M&A to move into device protection, identity theft protection. You see there on the left sort of earnings calls mentions of SquareTrade over time and how they talking a lot more of it to the investors, about growth as well. And you see some of the supplementary acquisitions that they added to bolster SquareTrade as it continues to grow. So things like Plum Choice, which is working on just sort of services for IT, and internet and cloud, as well as iCracked, which could potentially bring sort of on-site repairs, mobile repairs for SquareTrade. So it's bolstering that business a bit. They also acquired InfoArmor in the identity protection space that they are offering through their employee benefits channel. So Allstate, one example of this. Munich Re is another in which they've acquired firms like Relayer in order to advance their IoT strategy. So Relayer is sort of an IoT middleware platform. But again, just examples of potentially insurers making these bets in light of the fact that some investors may believe that the capital is better spent elsewhere. But it'll be interesting to see whether others take note. On the life insurance side, given that obviously a lot of life insurers are also in the wealth management business, one area that we hear a lot more conversation about is financial wellness. You see there news coverage of financial wellness. We're not going to recount some of the stats around, paycheck and how especially Americans today are living in terms of financial wellness. But there are a lot of figures available that are out there, and we have seen some growth both in terms of companies that are acting as platforms that are going through the employer channel, as well as companies that are going direct to consumer. So EarnIn, for example, is an app that allows employees to gain up between $100 and $500 interest free, but provide a tip occasionally if they want to. And we've seen a number of companies represented by EarnIn users, which is going direct to consumer, grow from 250 touching over 50,000 in just 4 years. So certainly significant growth for these financial wellness products. We expect some of the large life insurers to actually bolster some of their efforts in this space and perhaps launch more products, or maybe even look to M&A on this side as well. And then the other thing, another topic we're looking at before we wrap up is sort of changing dynamics in home insurance. One thing that has come up is that insurers now have access to much more sophisticated underwriting and certainly data sets for home insurance. And this provides more of an opportunity for new business growth when they're looking at home insurance versus maybe other lines like auto. Just one example here, some of the mapping companies now have access to a large portion of the U.S. population. And if you layer on top of that the advances that we've seen in machine learning and as well as image classification, presents a lot of opportunities to become much more sophisticated, in which that can be a big bolstering for new home insurance business. In light of that, we've seen startups, for example, look to take advantage of this by using data and analytics to reshape some of the customer experience, taking all sorts of different data sets like satellite imagery and municipal building records, which is quite interesting and different than what we've seen in the past. And we've also seen a lot of integration with sort of the home buying process now. So new home buyers, which is a very attractive segment for home insurance companies. We're seeing some of this integration take place with some of the largest platforms like Blend, which is processing a same amount of the new mortgage applications going through its software as they work with large banks. And they just recently launched a home insurance agency that really tied the home insurance process to the mortgage and making it a lot easier to close a home. And we expect to see more of these types of efforts over time, whether those are alternative mortgage lenders, as well as maybe even some of the large data providers to the home insurance industry, becoming more integrated into the distribution side as well. So a lot to take in there. As home insurance also gets more attention, we believe there will also be more developments on the claims side as well. Hover, for example, is one company that's working with a number of different insurers and taking advantage of advances in technology as well as verticalizing those four offerings. So certainly in Hover's case, it's the mobile channel as well as what they can do with understanding sort of the interior of homes and how that can play into claims adjusting as well. So a lot more to be done there on the home side. But if you think about what happened in auto and virtual auto claims, which is now significant amount of carriers using the technology, we expect to see more of this on the home insurance side as well. Lastly, we'll just touch briefly on life insurance. This is a more of an illustrative map, but if we think about the life insurance value chain, we're seeing a lot of startups crop up in different aspects of it, whether those are distribution or risk classification. And this is very simplified. A lot of companies are working across different areas as well. But certainly we have seen more life insurance startups, despite the fact that PNC is sort of taking the larger portion of deal flow to startups in the space today. And we've also seen some bigger efforts from carriers as well. So the big one that we tracked last year, obviously, was John Hancock doubling down on Vitality. This is now offered on all new life insurance policies. And they're offering discounts at places like Amazon and REI for reaching health milestones, but they do not necessarily offer annual health premium savings for this. So they did just recently launch a big new sort of marketing campaign for their products. They've believed that about 40% of new customers have opted to add Vitality. And you can see some of the figures here in terms of John Hancock, a new term life policy value. But what'll be really interesting to see if whether this sort of engagement really takes hold for their policyholders. Thus far, we did see initial uptick when this happened in terms of downloads of the Vitality app, but we haven't really seen it grow significantly since then. In fact, actually probably more on a downward trend since then. So it will be interesting to see, what the effort of this program looks like, especially as they add more sort of marketing resources towards it. And lastly, we'll just touch a little briefly on the insurance startup side, on the term life startups. I think one thing that we've seen that's interesting is that there are a lot of startups pursuing innovation around coverage or thinking about sort of how creativity around sort of the life insurance policy. But I think the thing that we're noticing more is that distribution channels, especially for the number of term life startups that are out there today, is becoming sort of more of an imperative, especially if you track just mentions of these partnerships over time, whether the channels are through the HR benefits platform channel, that's through the advisor channel. It could eventually even be through the mortgage channel and through firms like Blend, for example, perhaps. But I think this will be a bigger aspect if term life startups are to succeed in this model. Is really we'll be looking at how they evolve in terms of distribution, where they are scaling their policies both from direct to consumer and also through some of these new B2B to C channels that they're looking to grow into over the last few months. So we did cover quite a bit there. There is a lot we didn't cover. Cyber insurance is a big one that we just released in our report with Willis this week, so I'll encourage you to take a look at that. And there's a number of other topics that we'll continue to dig into through our newsletter, which you can subscribe to on the CB Insights website, and we release that every other week. So we'll be touching on a lot more of the topics, including the ones that we touched on this briefing in the coming weeks and months. So With that, I think we'll just close up and take a few questions. Let me just take a look here. Here are the questions. So we did get one question here. What is the valuation of Cambridge Mobile Telematics? We do not have a disclosed valuation. They did take a $500 million investment from SoftBank earlier. And how do you justify SoftBank's investment? So we can't sort of justify, but we can talk a little bit about Cambridge Mobile Telematics. So, CMT was launched in 2010 as an outgrowth of the MIT Computer Science and Artificial Intelligence Lab. So their DriveWell platform is used today by over 30 insurers, and they have some big contracts, including State Farm and Liberty Mutual in 20 different countries. We did touch on this in our newsletter a little bit, but it's interesting to think about how does Cambridge Mobile actually generate revenue. So that's actually through three ways. One is through the telematics service revenue, in which they're just converting data to this raw sensor data to telematics data for insurers who are just paying them on a per user or per month basis. They also obviously charge for the IoT device, and then also smaller revenues associated with white labeling and special projects. So over time, I think the SoftBank, especially as they think about their investments, is more of an ecosystem, whether that's in food delivery or mobility and on-demand and ride-hailing. I think you'll start to see a little bit more of a focus there, which remains to be seen today. But I think that's sort of where it's going, is adding on, not just gaining share of sort of the telematics insurance market, but also expanding into new areas like mobility and other areas. So I think that's going to be sort of the focus for them over the next few years. So what are the trends you see in the health insurance industry in applying technology? There's quite a bit. The briefing today largely touched on just PNC and life, and we have been doing a lot of good research on especially the Medicare Advantage market. So I direct your attention there in terms of what we're seeing. And we've also done some very lengthy analysis of firms like Oscar Health and others. So I'm not going to touch on health insurance too much, but it's a briefing we might do in the future. So I'll leave it to that. Who are the most active institutional investors in InsurTech? I don't have the list off the top of my head. There are a number of different venture capital firms that have made a number of investments in the space. I can name a couple of them who are active, firms like Oak HCFT, firms like Ribbit Capital, and a number of others, actually, quite a bit. So maybe that's something that we can release. We do have a list of most active fintech investors that we put in our recent report, but we can certainly sort of release that data based on the number of investments over the last few years. So I think we can take one more question here. Let's see. So is there still interest for PNC distribution for personal lines like auto in the U.S.? I don't know if that's related to investor interest or insurer interest to look toward alternative distribution. I can probably try to address both of them. I think in terms of new investments into PNC distribution, I do think we've seen a bit less, although this is a lagging indicator. We don't know whether there are more investments still to come, and it could be. But we did see a number of PNC distribution focused startups raise capital, or and certainly a lot more startup formation in the space. But we do continue to see it. All right, there's new startups. Just recently, Nobler, for example, an auto startup, it's backed by White Mountains, just went sort of more public with what they're doing, and I think we'll continue to see more iterations and models. But certainly it may be less than the wave of companies that we saw over the last 2-3 years. But I think there will always be potential for new models or propositions to take hold within the industry. And then on the insurer side, well, maybe not on the insurer side, but on the strategic side, I also think there will be potentially more developments there as well. I think there's larger players that are also interested in auto insurance as a potential revenue opportunity or others. And we recently saw Cox Enterprises, for example, take a stake in insurance startup ClearCover and others. So I think there still remains to be seen. We also see large players like aggregation platforms like Credit Karma start to wade into the auto insurance industry. So still a lot of developments to come, and certainly we'll be keeping track of those over time. So we'll take the rest of the questions, I think, offline and send those over when we have answers. And we'll also be sending the deck to you in the next 24 hours. If you have any other questions, feel free to email me, mwong at cbinsights.com. Thank you very much, and we'll see you next time.